Yeah. So any query on NPV calculation? So I hope whatever we discussed on NPV up to that, so the concept is clear. Now, shall we go with perpetuities? I request the participants to mute your speakers. Yeah. Yeah. Once again, good morning to all. Yeah. So discounting perpetuities. In the previous discussion, we had a discussion that how to calculate the NPV when there is a limited cash flow. It means if you can predict the cash flow from a project and how to go with the NPV that we discussed. Now, in this discounting perpetuity, perpetuities is nothing but if you are expecting the annual cash flow forever. So there is no specific period. We can't say that the cash flow will be for 5 years or 10 years. If you are expecting the cash flow from a project forever, it means that there is no specific limit. In that case, we do consider it as a perpetuity. Now, in this perpetuities, how we can go with, how we can calculate the present value. Now, generally, it is often described by examiners as a cash flow continuing for a foreseeable future. So, it means that in order to understand the perpetuity, so generally the examiner will be mainly quoting that the cash flow will be continued for a foreseeable future. Now, here foreseeable future is nothing but forever. So here you can see the present value, the formula for calculating the present value of perpetuity would be the cash flow. So whatever the cash flow which we are expecting divided by the discount rate. Suppose if you are considering the discount rate at 8%, then cash flow is 10,000. So 10,000 divided by the discount rate, we'll be getting the present value of that particular perpetuity. Now, the present value of a growing perpetuity is found using this particular formula. Here you can see the formula for present value for growing perpetuity. It means what is the difference between growing perpetuity and this? In this case, if you are expecting the perpetuity to increase every year, then that is known as growing perpetuity. So you can find the formula for present value for growing perpetuity also. Okay, now we try to understand this with a small example. So here you can see the test your understanding 8. Just one. Yeah. So let me explain it in Excel sheet. I hope I am audible to all because it's showing that my internet is unstable. So please let me know whether I'm audible or not. Yeah. Okay. The ratio understanding 8. Calculate the present value of the following, assuming a discount rate of 10%. Now here we should consider the discount rate of 10% and we should calculate the present value. So two cases are there here. If you are receiving 3,000 in 1 year time and forever, it means that if your expected cash flow is 3,000 and if you are expecting the cash flow for a foreseeable future, and in the second case, we will be receiving 3,000 in 1 year's time and it will increase 2% per annum in perpetuity. It means every year we are expecting an increase of 2% in the cash flow. So the first one is a uniform cash flow and the second one is a growing cash flow, nothing but increasing cash flow. So first we try to calculate the present value for a uniform cash flow. That is very simple. So the formula to calculate that is the expected cash flow. So expected cash flow is 3,000 and divided by the discount rate. So here the discount rate is 10%. So the present value of this foreseeable or the perpetuity will be 3000. So the present value is 3000, and I hope it is clear. Sorry, it is 30,000. Small clarification. So the present value is 30,000. So I believe you understood the formula for calculating the present value of perpetuity. Is it clear? Now we'll calculate the present value for growing perpetuity. Now here in this case, in the case 2, we can see that the annual cash flow is 3000, and we are expecting that this particular cash flow will increase 2% every year. Now in that case, the formula would be 3000, that is cash flow, divided by, now this is very important, same discount rate. Our discount rate is 10%, or we can also say consider it as 0.10, minus the growth rate. So how much we are expecting here? 2%. So it means 2% is nothing but 0.02. So the present value of this growing perpetuity would be 37,500. It would be 37,500. So any query do you have on this? So the first scenario is just we calculated the present value if you are expecting the cash flow for a foreseeable future, right? Yeah, okay. I will be explaining it once again, Anita. So first try to understand what is this perpetuity. Perpetuity is nothing but if we are expecting the cash flow for a foreseeable future, that is known as perpetuity. Now, the simple formula to calculate the perpetuity would be the expected cash flow divided by the discount factor. So in this scenario one, in the case one, how much cash you are receiving every year? $3,000, right? And our discount rate is 10%. So the present value would be 3000 divided by 10. So it means 30,000. So the present value of expected cash flow of 3000 for a foreseeable future is 30,000. But in case of second case, we are expecting 3000 every year, and this 3000 is going to increase 2% per annum for a foreseeable future. So in that case, we will be applying this particular formula. Just see the formula here. The expected cash flow is 3000 divided by difference between the discount rate and the growth rate. Difference between the discount rate and the growth rate. So our discount rate is how much? 10%, nothing but 0.1. And our growth rate is 2%, that is 0.0. So if you apply the formula, the present value of the growing perpetuity would be 37,500. So I hope the present value calculation for this perpetuity is clear. Is it clear? Yes. No. No, this is very important point. Advanced and delayed annuities and perpetuity. Now, first we try to understand what is this advanced and delayed annuities and perpetuity. The use of annuity factor and the perpetuity factor both assume that the first cash flow will occur. See, if you can recollect in my last session also, if you are investing on, let us assume that if you are investing the amount on the project on 1st January, we expect that the project will be giving the return after 12 months. So it means that we will be the cash flow will be occurring from the project in 1 year's time. Now, so annuity or perpetuity factors will therefore discount the cash flow back to give the value 1 year before the first year cash flow arrives. Now, for standard annuities and perpetuities, this gives the present value. It means that if you are expecting the cash flow after 1 year, so the main objective of this annuity factors or discount factors is what is the value of that particular cash at the time of investment. So T0 is nothing but investment period, and we'll convert the T1 values into T0. This is a normal procedure which we apply. But In case of advanced annuities and perpetuities, some regular cash flow may start immediately. This is very, very important. It means that when you invest in a project, we can expect that the cash flow from the project might start immediately. So instead of considering the cash flow from T1, here we need to start it from T0. Now, in that particular case, whenever advanced annuities and perpetuities are there, we need to ignore the present value for the first cash flow. See here you can see calculate the present value by ignoring the payment at T0 when considering the number of cash flows and then adding to one of the annuity or the it means adding to the annuity or the perpetuity factor. So for your better understanding, here there is an illustration. Still I can see that some students are joining, so please join as early as possible. Yeah. So a 5-year 600 annuity is starting today. So it means that 5-year 600 annuity means the cash flow is starting today and the expected rate of interest is 10%. Now we should calculate the present value of the annuity. Now in general, how we used to consider if you are receiving a cash flow from a project, we used to start it from T1. But in this case, the annuity is starting immediately. So it means instead of going with T1, we need to start our cash flow from T0. So 5 years means T0, T1, T2, T3, and right. So then, as I mentioned earlier, if your cash flow is starting immediately, we should not calculate the present value of the first year, and for the remaining years, we need to calculate it, and it should be added. In simple terms, what I'm trying to say, at the rate of 10%, just we need, because here the cash flows are even. So there is no change in the cash flows. The cash flows are uniform. So we can refer our annuity table and at the rate of 10%, whatever the factor is there, that we can consider. So here you can see the annuity factor for 4 years, it will be 3.17. So 600 into 3.17 plus 600. It means that so the total present value of the project is 2050. So the same answer can be found more quickly here. You can also add this. So simply by adding 1, because for first annuity factor, we assume it as 1. So that can also be done. So the logic behind here is very, very simple. When your cash flow starts immediately, don't calculate the present value for the first year cash and calculate the present value for the remaining cash flows and add the first year value. So whatever answer you get, that is known as present value. Now I request the participants to please once go through this calculation. And if you have any query, you can ask. Yeah. Is that clear? Okay. Yeah, definitely I will be repeating it, James. Don't worry. Here, Jerome, your query is how we got 3.17. Now let me show this. Uh, let me open my. Yeah, I will be explaining it. I hope everyone can see my screen. Can you see my screen? Yes. Now just I splitted my screen. I believe you can see both the table and the question, right? So here the first point. A 5-year 600 annuity started today. Now annual it means that we are receiving a cash flow of 600 every year. And the first cash flow was started immediately. So the first cash flow started immediately. And the discount factor is 10%. Now in this case, how we need to calculate is the first, because the first cash flow is starting immediately, you need not convert it into present value. So the first 600 should not be converted into present value. So that is the step number one. I hope the first point is clear. Because the cash flow is starting immediately, we should not convert this 600 into present value. This is the point number one, which you need to remember. I believe you understood that. Is it clear? Now, the remaining 5 years or whatever, remaining 4 years. Now, remaining 4 years also, every year we are receiving 600. So, for that particular remaining 4 years, we need, because the cash flows are same, every year we are receiving 600 only. Just open your annuity table. So, this is your annuity table. Okay. And how many periods we are considering? 4 years. We are considering 4 years. And what is the discount rate? 10%. So, in the annuity table, at the fourth year, just see the 10%. So what is the value here? 4 years at 10% discount rate. How much value there is? 3.170. I hope you can see this, right? 10, you need to see for the 10%. And number of years is 4 years. So this 3.17 into 600. How much you will be getting? 1902 plus the first cash flow of 600. So the total 2502 is considered as present value. Can I assume that you understood now, James and others? Yeah, present value tables can be considered here. Here we can go with the present value tables, but it will take time. That's it. In order to minimize the time, we are using this. That's it. Okay. So the only agenda is to minimize the time. That is the only agenda. Is that clear? Now, let me ask a small question. Suppose instead of 600, if your annual cash flow is, let us assume that 1000, and the first 1000 starts immediately, and your interest rate is, let us assume that 8%. So number of years are 5. If possible, please make a note of it. Number of years are 5. The first cash flow of 1000 starts immediately, and remaining 4 years cash flows, the discount factor is 8%. Now, can you calculate the present value now? What will be the present value? Excellent, Naina. 4,999. Perfectly correct. Very good. So I hope the concept is clear now. Yes. Any participants? Any query? Yes. Now, now advanced perpetuity. Now perpetual 2000 is due to commence immediately. The interest rate is 9%. What is the present value? So this is essentially a standard perpetuity with an additional payment at T0. Now in this case, advanced perpetuity means down payment. See, every year we receive the cash flow of 2000, and in addition to that, an amount has been received towards the, it means that an advance. So here you can see every year we are receiving 2000, and it is perpetuity. Perpetuity in the sense we don't know how much, what is the period. Here you can see, right? Now just see this one. So what is the formula which we generally use for the advanced perpetuity? Or generally for perpetuity, what is the formula we use to calculate the present value? So here you can see the perpetuity 2000 is due to commence immediately. The interest rate is 9%. Now normally the formula is 2000 divided by 9%. I hope it is clear. But in addition to the cash flows, we also received an advance amount. So there is an advance perpetuity of 2000. So in that case, let me show. First, we should calculate the present value of perpetuity. So in this case, the cash flow is 2000 divided by rate of interest is 9%, so 0.09. So our value is, I hope you can see this. So it is 22,222, right? And in addition to this, we received an advance value also. So here you can see. So total 22,222 plus initial advance 2000. So total it will be 24,222. Add advance amount. Leela, I didn't get you. Which answer you are speaking about?
So the before one, sir. The one which you gave 1,000 rupees.
Yeah, just let me ask, is my voice clearly audible?
Yes, sir.
Yeah, okay. So you are asking about the example which I asked, right? Okay.
Yes, sir.
Okay. Now let me once do that. So I said that the annual cash flow is 1000, right?
Yes, sir. 1,000, 8%,
Okay.
5 years, sir.
So 5 years. But in that 5 years, first year we are receiving immediately.
Yes, sir.
Yeah. So 8% means 3 point. Sorry, 4 years.
312.
Yeah, 3.312. So so 3 point. Yeah. Sorry, small correction. It is. Naina, just one secure answer. It is 3.3 plus initial 1000. It will be 4,312. I believe you might have considered the 5 years value. Now here, see, once again I repeat, it is completely your wish. Suppose if your cash flows are even, if you are expecting same cash flow every year, always it is recommended to go with the annuity table. If there is no change in the cash flows every year, if you are receiving the same amount as cash flow, then go with the annuity table. And if the cash flows are changing, then you should go with the present one. If the cash flows are same, you can go with the present value, but unless it increases your time. So in order to minimize the time, directly you can consider the annuity table and you can go for the calculations. But if the cash flows are changing means first year it is 1000, second year it is 1500, and third year again it is 2000. In that case, we cannot apply the annuity factor. So we should go with the present value table. But if you are expecting same 1000 every year, then you can go with annuity table. I believe you understood now. Is that clear? Yeah. Now in this case, let me project the question. Yeah. So here advance perpetuity, in the sense we will be receiving a regular cash flow and for a foreseeable future. And in addition to that, if you are receiving 2000 in advance, in that case, first we should calculate the present value of the perpetuity. Once again, I repeat the formula, that is expected cash flow divided by the discount factor or nothing but the interest rate. In this case, the interest rate is 9%. and the expected cash flow is 2000. So 2000 divided by 0.09. So then we got 22,222 as the present value. In addition to that, as an advance, we received another 2000. So the total value of the value will be 24,222. So this is the computation process for advanced percentage. Any query on this? Because these are section A MCQ, we can expect a query on this. Yeah, in exam they will be providing annuity table and the present value table. Don't worry about it. Okay, in FM paper you will be getting that. Now there is one more question, additional question. Find the present value of the following cash flows. A 15-year annuity of 300 starting at once. Interest rate are 6%. A 15-year annuity. Here they mentioned about a 15-year annuity. $300 starting at once. Interest rate are 6%. So what will be the present value? What actually they are asking us to calculate? 300. Is it 300? How to go with this? 3,888. Okay. So Adhika thinks 3,888. Any other answers? Okay, let me explain this. First, for 15 years, we need to see the annuity factor. So for 15 years, we need to see the annuity factors at a rate of 6%. Now, let me show that. Okay, so I think most of you got 3,888. Now let me clarify this. First, let me. So what is the annuity for 15 years at 6%? It is 9.716. I hope you can see this. At 6% factor, the annuity is, yeah, sorry. In this question, 15 years annuity 300 starting at once. So starting at once means immediately it is starting. So immediately starting means we need to consider the annuity factor for the remaining year, that is 14 years. So for 14 years, the factor will be, yes, we should consider the 14 years. So the 14 years, what is the annuity factor? So the annuity factor for 14 years will be 9.295. And I hope this is clear. So 9.295. And what is the value here? Present value for this? So the total amount contributed is 300. So we got a present value of is that clear? 2,788. I hope it is clear up to now. Now then initial cash flow. So the total value will be 300 plus 2,788. Now the next one, a 7-year annuity of 450 starting immediately. Interest rates are 11%. Now I am expecting you to give the answer for this. 7-year annuity of 450 starting immediately. Interest rates are 11%. So what will be the answer? 2,353.95. Yes, and I don't think I need to give any further clarification on this. A perpetuity of 14,000. Now do remember the next one. Sorry. Third one, a perpetuity of $33,000 commencing immediately. Interest rates are 22%. So simply just we need to apply the formula here, and a perpetuity of 14,000 starting at once. Interest rates are 12.5%. Now, can anyone calculate the fourth year? Just leave the third one. Third question. Just go get the fourth one. A perpetuity of $14,000 starting at once. Interest rates are 12.5%. So how we can calculate the present value in this case? Rate of interest they gave it as 12.5%. I hope you are going with the calculation. One lakh 12,000. Okay. So two different answers I am getting. One participant gave 1,26,000 and one participant gave 1,12,000. So here you see 14%, 14,000 divided by 12.5%. So you will be getting a value. So how much? 14,000 divided by 12.5%. So it will be 1,12,000, right? Plus the first advance amount 24,000. So the total comes to 1,26,000. Is that clear? So I want everyone to please respond for this. If you have any query on this calculation, please let me know.
So can you tell that once more?
So 24,000 here you can see. Sorry. Sorry, it is 14,000. 1,12,000 plus 14,000 will be 1,26,000. Because immediately 14,000 was paid as an advance, and the remaining 14,000 will be receiving as cash flow for a foreseeable future. So first for 14,000 and the interest rate 12.5 we calculated, and we got 1,12,000, and we added the advance amount which we received, that is 14,000. So the total value will be 1,26,000. Okay. Now this is the process for calculating the advance. If you receive any advance, so this is the procedure. Now if you are clear with this, we'll go with the delayed payments. You want me to explain this one? So actually at present I don't have the answers. So here 7-year annuity 450 is given, starting immediately. Okay, answer. Yes, we need to go back to the answers once. 7-year annuity of 450 starting immediately means just open the annuity factor for 6 years at 11%. So 11% for 6 years. So it will be 4.231. So 4.231 into 1903 plus 450. Okay. So it is 2350. 350. For third one, a perpetuity of 33,000 commencing immediately. Interest rates are 22%. Now, in this case, perpetuity 33,000 is, yeah, we can go with the same procedure. Okay. Any questions? Now, shall we discuss the delayed annuities? Answer for third one. How much you got, Mohammed? Okay, 1,83,000. Okay, sorry. Yes. Okay. Now the next thing is if the payments are delayed. See, not necessary that always the first cash flow starts in T1. So there might be a possibility where the cash flow might start delayed also. It means instead of start expecting the cash flow after 1 year, in this case we can expect the cash flow after. You didn't understood the first one. What was that first one? A 15-year annuity 300 starting at once. Interest rates are 6%. So annuity is 300. So just we need to go for 14 years annuity table. So at the rate of 6%. So here you can see at 14 years at the rate of 6%, your annuity factor is 9.295. So 9.295 into 300. 9.295 into 300. Here you can see. So we got 2788.5 plus the advance amount of 300. So the total value will be 3000. Because it is a 15-year annuity, but the first cash we are receiving in advance. It means immediately we are receiving it. So we are considering only 14 years annuity. So 300 into the annuity factor for 14 years at the rate of 6%, and the result which we get to that, we will be adding the initial value of 300. So the total answer for the first one will be 3080. Okay. I hope it is clear, Nandita. Yeah. Now delayed annuity. So as I mentioned, if you are not receiving the first cash flow immediately, suppose instead of receiving the cash flow in T1, if you are getting if you are receiving the cash flow at T2, then it should be considered as a delayed cash flow. Now let me explain a delayed cash flow. Here you can see what is the present value of 200 incurred each year for 4 years, starting in 3 years time, if the discount rate is 5%. So it means that in 2020 we invested in a project, okay, and we are expecting 200 each year, but it starts from T3. Here you can see starting in 3 years time. So we are not receiving it in the first 2 years, we are receiving it in the 3 years time. And what is the period? 4 years. So T3, T4, T5, T6. I hope you can see the table here. Right? Now, in that case, how to calculate the present value? Very, very simple. First, the step number 1, we need to discount the annuity as usual. Normally, by considering the annuity, we need to discount it. So 4 years at 5%. So 4 years at 5%, the annuity factor will be 3.546. Okay, so 3.546. So 200 into 3.546, we got 709. See, this is very, very simple, but you should understand this. Because in this case, the annuity is delayed by 2 years. It means instead of expecting the annuity in the first year, the annuity is getting from the third year. So first, and how many years we are getting the cash? 4 years. So first we calculated the annuity factor for 4 years by considering the 5%, because 5% is given as a discount rate, and we got a value of 70.2, 709. I hope you understood this. Is that clear? Now let me know whether you understood the step number 1. Is it clear about the step 1? See, whatever normal process we applied, the same process we applied here. Just the annuity is 200 and the annuity factor for 4 years at the rate of 5% is 3.546. So we got 709. Now the step 2 would be, say this 709 is for the second year. Note that this gives a value of an annuity at T2. Now again, this value should be discounted back to our T1 value. Nothing but we need to calculate, to our T0 value. So 709.2 into 2 years, 5% discount factor. So what is the discount factor? Let me show. So this is the 5%. At 2 years, the discount factor is 0.90. So 2 years 0.909. So it will be 6,000. Is that clear, or you want me to put it in Excel sheet? Did you understood this? Yes. Okay, let me put in Excel sheet. Suppose we started a project on 1st January. I want everyone to please focus on this. 1st January 2020. Right? So the start of the project is 1st January 2020. Generally, we expect the returns from after 12 months. So the return from the project, the cash flow from the project will be expecting after 12 months. It means that on 1st January 2021, we should get the first cash flow. Then on 1st January 2022, second cash flow. Okay. Now normally we say it as T0. This is T0 and we consider it as T1, T2. Now these are the P values. I hope this everyone understood. Is that clear? Is that clear? Now, actually in this particular query, instead of starting this cash flow in the T1, we are receiving the cash flow from T2, sorry, T3. So from T3 onwards, we are receiving the cash flows. But present value means what is this value on T0? But in the previous cases, our cash flow started from T1. But in this case, it is delayed by 2 years. And it started from third year onwards. So from T3 to T6, remaining 4 years. Here you can see the question. $204 years. So it means that we are starting it from T3, right? Now, what we need to calculate, what is the value of cash flows? What is the present value of the cash flows, which was starting from third year in T0? So this is, we need to calculate for the T0. So for that, the step number 1 is, first we should calculate the present value at T3. Sorry, present value for T0. Sorry, we should calculate for the present value for T2. So how to calculate the present value for T2? For that, you need to open your annuity table. In the annuity table, at the rate of, what was the interest again? 5%. At the rate of 5% for 4 years, it is 3.546. So 200 into 3.546. So 709.2 is the present value at T2. Is that clear? Did you understood the step 2 now? Step 1, sorry. But finally, what is, we need to calculate the present value for T0, right? We need to calculate the present value for T0. So how to calculate that? So for calculating the present value at T0, just go to your discount table. Our rate of interest is 5%, 2 years. It is 0.907. So 709.2 into the present value, that is 0.907. So 643.44, 643.24 is the present value. It means if you are receiving 200 for 4 years from the third year, its present value in the T0 is 640.2. Okay. Any query on this? Now, in that here, why I took, in this question you took the previous year value. Say in case of annuity, in that case, the amount was received immediately. Now, say total 5 years. Let us assume that if the total term is 15 years, and in that particular 15 years, first is received immediately. Normally, we will be receiving the cash flow after 12 months. But in the previous query, we received the first installment in advance. It means that the first cash flow was received immediately. So that's why remaining 14 years I consider. I consider from the next year. Did I address your query? Yeah. Now, shall I give one more question on this? Will you try a similar query? Yeah. Suppose example annual cash flow is 2000. Annual cash flow starts from second year. Interest rate let us assume that 8%. So annual cash flow 2000, it starts from second year, interest rate 8%. So just please try this. Sorry. Sorry. For 3 years. If anyone want me to show the annuity factor, I will be showing that. Should I display the annuity factor? I hope it is available now. Yes. Just I am projecting the annuity table also. So want you can see.
ശരി ശരി അതിലൊന്ന് മറന്നേ
4,772.60. Okay. So one participant, I got an answer from one participant. 4,772.60. Others. Yes. Very, very good. Now let me see whether your answer is correct or wrong. So 2000 into 3 years, right, at the rate of 8%. So 2.577. So 5,154. And it was in the second year. Now we need to convert into T0. So at 8%. So it will be 0.926. Very good. So I hope, is it clear? Is the concept is clear? Because the most commonly asked question as an MCQ, delayed annuity. So delayed annuity is the most commonly asked question. So just I'm leaving it as your homework. So I hope you can try it. So shall I skip this additional question? So please try it. If you have any query, you can ask. Okay. Now there is an important information regarding this. So just see this. In the construction response spreadsheet workspace, you can be made of spreadsheet functions to speed up the construction of answers. And for instance, clicking on the bottom right corner of the cell, very, 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 very important, because most of the students are unaware about this and they will be wasting the time. Clicking on the bottom right corner of a cell and dragging the cursor across the other cell will copy the contents of the original cell into the other cells. And this is particularly useful for copying the formula such as totals. And formulas such as sum, power, and square root are available within the spreadsheet workspace. Because why they are specifically focused, this is normally all the functions or all the functionalities of Excel is not available in your exam spreadsheet. Only limited functions are there. Generally, it includes multiplication, sum, power, square root. These are available. It means what I am trying to say here. See, there are certain functions like suppose if I speak about the present value, so directly from your Excel sheet we can use the present value formula, but this present value formula will not be available for your exam spreadsheet. Okay, so directly you cannot go with the formulas, the ready-made formulas which generally available in the Excel sheet. So here you can use square root, power, sum, and addition, subtraction. These are available. So for your better exposure, as I mentioned earlier, once please log into the practice platform, just see that, so that you can understand the functionalities. So whenever you get free time, please once go through the practice platform. Okay, so that is about the present value calculations and the NPV. So I believe the concept is clear. Shall we go with the next method, internal rate of return? Yes. Any queries on the this discussion? Present value with perpetuity, growth, changes in the cash flow, and delayed payments and advance payments. Yeah. Now the next method of investment appraisal technique is internal rate of return, or we generally say it as IRR. Now IRR represents the discount rate at which NPV of an investment is zero. It means that what should be the discount rate at which we will be getting NPV as zero. Because in case of net present value, I hope you might have remembered this, we convert the present value, we calculate the present value of expected cash inflows, and we'll deduct the investment from that. And if you get a positive value, that is known as a positive NPV, which generally considered for selecting the alternative projects. But in order to know what should be the discount factor, at what discount factor the NPV will be zero. NPV zero means the present value of expected cash inflows is equal to the investment. Suppose if I am investing in a project $1 lakh, let us assume that I am investing $1 lakh in a project, and if my present value of the future expected cash flows is also 1 lakh, in that case I will be getting NPV as zero. Now internal rate of return is nothing but the rate of return at which NPV will be zero. Okay, IRR represents the discount rate at which NPV will be zero. I hope you are, it means we can say that this is a break-even rate. Now break-even rate means where there will not be any positive NPV or negative NPV. Okay. So in this case, the project should be accepted if their IRR is greater than the cost of capital. So let me give more information on the decision rule. Now the main objective of calculating the internal rate of return is, first we will calculate IRR, then we'll compare the IRR with the cost of capital. Now comparing the IRR with the cost of capital means, let me project it in the Excel sheet. Suppose a company borrowed a fund let us assume that they borrowed a fund of $1 lakh. They borrowed fund of $1 lakh, and with this 1 lakh, they want to start a project. So with this particular 1 lakh, they want to start a project, and they are paying an interest on the borrowed funds at 10%. So it means they are paying an interest of 10% on this 1 lakh, and with this 1 lakh, we are starting a project. Now, what would be the minimum rate of return, or what would be the minimum return which we will be expecting from the project? At least 10%, right? If the project won't give minimum 10%, then definitely it will not be viable. So in order to know, see, the main objective of IRR is to know whether the project is capable of giving a return of at least the cost of capital, whether it can meet the cost of capital. Suppose if the internal rate of return is less than the cost of capital, then definitely we reject the project. So the main objective is the rate of return which we are expecting from the project should be more than the cost of capital. So this is about the decision rule. So before we go with the further discussion, let me know whether you understood the concept of IRR. Is it clear? My voice is not clear. I'm saying now because some network issues, so that's why. So everyone facing the same issue? Am I audible now? Is it clear now? Hello. Hello. Okay. Now I hope now it is clear. Yeah, okay. So most of you might have not received this IRS. Let me explain this. Say internal rate of return is a return at which our NPV will be zero. NPV zero means the present value of expected cash inflows is equal to the investment. Okay. So the main purpose of calculating internal rate of return is to know whether the project is capable of giving a return which is more than the cost of capital. Because in order to start the project, if I need $1 lakh and if I am paying 10% as interest on that particular 1 lakh, whether the project can give a return of at least 10% or more. So we will be comparing this internal rate of return, or we can also say it as break-even return, with the cost of capital. And if the IRR is more than the cost of capital, then only we accept the project. And if it is less, we will be rejecting the project. So the main objective is whether the project is capable of giving a cost of capital. At least we can recover the cost of capital which we borrowed for starting the project. So this is about the introduction about internal rate of return. IRR, internal rate of return, can also be known as break-even return. So it is a point at which we won't be getting either a positive NPV or a negative NPV. Okay. So I hope the introduction is clear. If still same issue, or can you hear me? Yeah. You know, using the NPV method, present values are calculated by discounting cash flows at a given cost of capital. So we know this. Normally, how we will calculate the PV? We assume a specific discount factor, and by using that particular discount factor, we calculate the present value of expected cash flows in the future. And the difference between that particular present value and the initial investment, we do assume it as net present value. But in case of IRR, a discount cash flow analysis is to calculate the exact discount cash flow rate of return that the project is expected to achieve. So in this case, it means what is the discounted cash flow. So what is the exact discounted cash flow rate of return that the project is expected to achieve. If an investment has a positive NPV, it means it is earning more than the cost of capital. Now, and if the NPV is negative, technically it means that earning less than the cost of capital. So this means that if the NPV is zero, it will be earning exactly the cost of capital. So conversely, the percentage return on the investment must be the rate of discount or the cost of capital at which NPV equals to the zero. So the rate of return is called IRR, or the discount cash flow yield. So do remember, IRR, we can also say it as the discounted cash flow yield. And if it is higher than the target rate of return, then we assume that the project is financially viable. So in simple terms, if a company internal rate of return is more than the budgeted rate, then we assume that the project is financially viable. If it is less than the target rate, then it is not viable and it is not recommended to start or to go with the project. This is about the introduction of IRR. So before going with the calculation or the formula of IRR, let me know if you have any questions. I believe my voice is clear. Yes. Am I audible? Hello. Any query on IRR? Shall we continue with the calculation of IRR? Thanks for the response. Now here you can see the formula for calculating IRR using the linear interpolation method. So IRR is equal to lower rate of interest plus higher rate of interest, then NPV at lower rate of interest, then NPV at higher rate of interest. Now here you can see, anyway, after this we will be explaining this method. Now first calculate two NPVs for the project at two different cost of capital. You can choose any cost of capital and get a fair result. However, it helps to find two cost of capital for which the NPV is to zero because IRR will be value close to them. So ideally, you should use one cost of capital where the NPV is positive and the other cost of capital where the NPV is negative. Although it is not essential, you should not waste the time in the exam trying to achieve this. So once two NPVs have been calculated, then we can go with the cost. For your better understanding, let me explain in an illustration. Now let us assume that once everyone please look into the formula. The formula for internal rate of return. Just see the formula. Okay. Let us assume that investment, the project investment is 1 lakh. Then we need to take two discount rates. So the discount rate 1 8%. Next the second discount rate 10%. And let us assume that life of project 5 years. Okay. So in this IRR, first we should calculate the NPV at 8% and NPV at 10%. So can I expect the participants to do this? Will you try? Initial investment is 1 lakh. So we should calculate the net present value by considering discount factor at 8% and we should calculate the NPV by considering 10% discount. Will you try this or you want me to do? As per your wish. Yes. Now these are cash flows. So first we should take discount factor at the rate of 8%. Now these are the discount factors at the rate of 8%, and we should calculate the present value at 8%. So the present value would be so the total sum. So net present value at 8% is the total value, that is 1,74,540 minus our initial investment 1 lakh. So we got an NPV at 8%. NPV at 8%, that is 74,540. I hope it is clear now. Yes. NPV at 8% is clear. Now again we need to calculate the discount factor, discount rate at the rate of 10%. Now here you are not necessary that you should go with specific one. You can take 10%. But one thing is, if you are taking 8%, the second rate should be higher than this. So same issue you are finding. Is it same with all the participants or only zero? Please let me know. Hello. I'm very sorry for inconvenience because there is some network issue because of that. Is it clear now? Okay, then if that is the case, what we can do is we'll continue this IRR in the next session. So will that be okay for you? Hello. So what I just said is because some disturbance I think from my end. So shall we continue this internal rate of return in the next session? Shall we continue this calculation process in the next session? Okay. Yeah. Okay then. So yes. And some students asked me to clarify the doubts. I don't know whether I was able to do this or not because some disturbance from my end. So I will be clarifying your query on the next session. Okay. 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 So that's it for today. So yes. So we'll be going through the calculations of internal rate of return in next session. So I want everyone to please once go through the calculation part from your study text so that it will be easy when I explain the procedure for calculating. Okay. Yeah, we should calculate NPV for 10% also because you need to consider the discount factor 8% and 10%. Then we should calculate it. Okay. So I think we are having our next session on Monday, right? So on Monday, we'll be first covering this, then we'll discuss the next topic. Okay. So just I'm ending the session. So we'll continue the session.
Excuse me, sir.
Yes, yes.
Sir, is there any standard value of decimals we have to take for the sums we are doing? Like 2 points, 3 points,
Two decimals.
2 decimals. Is it compulsory to take 2 decimals? Because in the textbook, somewhere it's taken 3 decimals, somewhere they have off.
Compulsory you should take two decimals, but not less than the two decimals. Two decimals is compulsory.
Okay, so even if you take 2, not more than that, it's fine.
Yeah, it's fine. It's fine. Yes.
Because the value may be differing by
Yeah,
some.
I agree. It might differ. It depends upon the range of the amount. It might differ 100 or 20. So it won't be a big issue.
Okay,
Examiner
so
won't consider that.
yeah,
Okay.
the final answer will be correct, right?
Sorry?
The final answer, even if it's a tad different, it will be correct, right?
100%.
Okay, sir. That's all. Thank you.
Okay. So shall we continue the session on Monday? Or any other queries? Just I'm ending the session. So we'll continue on Monday. Okay.